In taxation, some of the issues that revolves around the global taxation is the use of tax treaties and the use of subsidiaries and parents existed in different countries, and as well the agreements of bilateral countries. So if we take, for example, a subsidiary that is located in Brazil, call it Coffee Brazil Company Limited, just an example, and it does everything here in Brazil. So at the end of the day, they will sell their products to Coffee USA Company Limited as the parent located in USA. Now, in Brazil, they also sell coffee, and in US, they also sell coffee. So the problem is, where is Coffee USA generates its profit from, or is if the profits made from Brazil, Coffee Brazil, are all accounted in Brazil? So the problem here is the US coffee is only marketing and selling, but they also made profits, and also Coffee Brazil made profit. Now, this sort of arrangement can have issues where these countries have double taxation treaty, whereby a profit that's been taxed in Brazil will not be taxed in US. Secondly is the use of bilateral agreements. So bilateral agreements, sometimes they exempted profits here in this scenario. The other thing is when Coffee USA has also engaged with trade and transactions with Coffee Brazil with its use of transfer pricing. So when transfer pricing comes in, we really don't know if the pricing that's actually bought from coffee in Brazil is in fact a price that is value at the market price. And so if it's not, then the question of the actual profitability that's generated in USA becomes a question of arm's length issue. Arm's length issue is when the profits generated from here, from America, is derived from a contract or agreement that's involved in the sale and buy of products within these two countries at a very lower price, and so the profitability becomes an issue here. So if these countries have different, these two countries have different taxation laws, as well as other laws of tax that are deferred in nature, then if they are not monitored and if they are not regulated, then one of these two companies will have to take advantage, or their operations will take advantage of which country will be able to be beneficial. So it's really have issues in regards to this sort of thing, the issue of transfer pricing, the issue of profitability, on which profit is derived from, and if the status of each country is independently calculated its own profit for the purpose of profit in its own jurisdiction. So these are the issues that are placed with difficulties around parent and subsidiary that's operated in different countries. So while this one is also explained and we understood, and that this is also a problematic issue, we've also discussed the Google scenario. So the Google scenario is called double Rs, that's sandwich treaty. So I've covered this one in one of the presentation, but this tax treaty shopping is also can be part of these issues too. And not only that, in Solomon Islands, for example, you have companies in Asia. They established to buy products in Solomon Islands. For example, the logging sector, they have loggers in Solomon Islands, established companies as well as holding companies, subsidiaries and then they sell products to logging Asian company in various Asian countries, and also with the Besdima industry, for example. This is another very lucrative industry, not only in Solomon Islands but across in the Pacific. But this industry, as well as logging, they fiercely involved in issues across the borders of the Pacific. So the challenge is also here, like if we have a company that's situated in Asia, and that's although they are not a parent subsidiary, but they are established established by shareholders and directors as connected by blood, for example, or they are siblings, for example. So if they establish companies on this nature, it's kind of very difficult to actually find out things between them, especially if they are related to issues that have discussed, related to transfer pricing, related to tax reduction strategies, and related to language barriers. So it's really have very difficult issues. It's not only Bedsteam, it also involves for companies like fishing industry, as well as the copra. In terms of the copra, for example, we have one company which I've already covered in a separate presentation related to Russell Island Plantation Estate Limited. These companies also have kind of subsidiaries that also can be caught under money laundering, which I've also covered in that presentation. So these industries, they tend to have Asians parent or Asian buyers. So with these issues here, if they are going to behave the way they are now, most of the whole subsidiaries or whole buyers companies that establish in third world countries like Solomon Islands, the country economies as well as the taxation, they lose out from this sort of arrangements. If we take one company example, one Asian buyer here, which I put the link down there, buyer here, he moved from Papua New Guinea to Solomon Islands without paying the vendors, the locally supplied bed steamers in Papua New Guinea. So when he moved, the Papua New Guinea, they thought that he escaped already to Asia. So he moved because Papua New Guinea, they closed the bed steamer season, Solomon Islands opened there. So when he moved there, the people thought that he left for Asia. But in fact, they are moving within the Asia Pacific, and as I said, we also have language barriers, so they probably have the same parent company, or the relative setting up buying a company from Asia. So when he moved across from Papua New Guinea to Solomon Islands, luckily the border was also open. So these people actually, they identified him in Solomon Islands. So there was a case here where when we cannot reconcile these companies as well as these buyers and these suppliers across the Pacific, so the problem in Solomon Islands, Papua New Guinea will be definitely obvious across the Pacific. But not only that, we can also extend the bed steamer to other products like fish, copra or copra oil, or the logging sector across the Pacific. We can also tell that given the difficulties we have with the language barriers across the Pacific, there are chances that these people maybe play the same game as that's been happening in Papua New Guinea and Solomon Islands. So the case in Papua New Guinea and Solomon Islands is not about them being tax evade and also setting up all these transfer price, etc. They are looking at the way these local people, they engage themselves and enable to get hold of these Asian who escaped from Papua New Guinea, and from there they ask him for some money to recover debts, and there were some criminal activities. So the concentration of this case is all about the criminal activities involving the local people there, as well as the buyers involved with criminal activity with this guy. On a corporate level, we did not, or Solomon Islands for that matter, did not have its taxation borders as well as the company borders able to look at these issues of transfer pricing if there is, and also able to put in strategies and mechanisms in place to protect that they actually maximize from this trade. So currently, as we do this presentation, this issue on coffee storage from Brazil and America is, whilst it's obviously detailed in other publicized booklet as well as research on this transfer pricing and taxation minimization across the globe, this also can be applied to developing countries such as Solomon Islands. And I'll give you the explanation that I have here in relation to this transfer pricing as well as the issues of arm's length buying and selling of products across countries which we have language barrier with. So this is it.